Hello and welcome to another episode of the Investor Financing Podcast, and I'm your host, Beau Eckstein. Thanks for joining in today. Today's show is we're going to talk about the differences between conventional versus a DSCR loan and what the advantages of the DSCR loan. So what is DSCR? Debt Service Coverage Ratio. So a lot of people have problems with what we call DTI, which is debt to income. They're trying to buy more rental properties in their name from a conventional lender, and they're having issues qualifying from the debt to income standpoint. Okay, push that to the side. That is why DSCR loans are available. We don't look at personal income. It's based on the cash flow of the property. We look at the cash flow of the property, and that's all it is. Cash flow, credit score of the borrower, leverage, LTV. That's it. Very simple. So if you're having issues with your debt to income ratio, because remember, you can only use 75% of gross rents on your conventional loans, right? So at some point it's going to be more challenging, or maybe you're just a self-employed and you write off a lot and it's hard to document your income. DSCR loans are perfect fit for you, and that's why you would use them. Now, sometimes the rates are a little bit higher, but remember, you're getting a loan in your business entity's name. Granted, you do sign as a guarantor, but there's a lot of advantages here.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau Eckstein here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. So, huge advantages to the DSCR loans. Everybody's talking about them. There's differences too with lenders. The lenders are all different. Some of them allow for projection based, right? We have a lot of people out there buying vacation rentals and there's no lease agreement. And we're doing a projection that this property is going to gross $75,000 a year annually. Well, some lenders will let you use the projections of your short-term rental. They have their own system of underwriting that. The majority of them don't. The majority of them say, listen, we're okay if you use it as STR, but it's got to qualify based on the LTR, which is long-term rental income. So if the long-term rental income qualifies at usually a 1% or better debt coverage ratio, they're okay with you buying the property and getting up to 80% of leverage. Actually, some lenders I see are doing 85% on purchase money, just depending on the deal. So you can look at these deals two ways if it's going to be a short-term rental. One is that what is a long-term rental? Will it debt service or come close to it? What's the debt service coverage ratio going to be as a long-term rental, even though it's going to be a short-term rental? The reason you would do that is because it opens up the gamut to more lenders. Because like I said, there's only very few amount of lenders that like to do the projection-based debt service coverage ratio loans. On the refinance, it's easier because you have a track record and more lenders like seeing 12 months of Airbnb or VRBO printouts. Anyways, that's the main difference between conventional and DSCR loans. Hope you enjoy this episode. Please like, subscribe, and share with your colleagues. Thanks so much for watching another episode. See you soon.